They call it a market anomaly. But on January 29th, 2026, the anomaly became the reality. Silver hit $121.66. The media called it a squeeze. The banks called it a bubble. But nobody is looking at the foundation. We are witnessing the mathematical breaking point of a 50-year lie. The paper market is flashing red, but the physical vaults are empty. This is not a correction. It is a reckoning. For decades, the price of silver has been dictated by paper contracts, not physical metal. They built a system where they could sell gold and silver they did not have, to suppress the price of the money they could not print. But in 2026, the math stopped working. Today, we are going to investigate the crime scene. We will look at the Hunt brothers in 1980, the banking spoofing scandals of the 2020s, and the industrial vacuum of 2026 that is sucking the global supply dry. We are sitting on a supply deficit that can mathematically never be resolved at current prices. The window to understand this is closing. To understand where we are going, you have to understand the first time the system almost broke. The year was 1980. The protagonists were the Hunt brothers, Nelson Bunker, and Herbert. These were not day traders gambling on an app. These were Texas oil tycoons who looked at the US dollar, saw the inflation flashing red, and decided to exchange their paper wealth for physical truth. They realized that the government was printing money to pay for guns and butter, and they knew that paper currencies always return to their intrinsic value, which is zero. So they bought silver. They bought millions of ounces. But they did something the banks did not expect. They took delivery. They did not want the futures contracts settled in cash. They wanted the metal, and the price went vertical. It moved from $6 to $50 in a matter of months. The banks panicked. The exchanges panicked. The entire paper facade was about to collapse because the Hunts had cornered the physical reality. So, what did the establishment do? They did not let the market resolve itself. They changed the rules. The exchange literally changed the leverage limits overnight and implemented Silver Rule 7, which stated that traders could only place liquidation orders. You could sell, but you could not buy. It was actually an assassination of price discovery. They crushed the price back down to $10. For 45 years, that was the lesson. Do not fight the Fed. Do not fight the banks. But the Hunts made one fatal mistake. They used leverage. They borrowed money to buy the metal. In 2026, the buyers are not using leverage. They are using cash. And that changes the entire equation. Fast forward to the modern era. The manipulation became more sophisticated. It moved from rule changes to high-frequency algorithms. We saw spoofing, where traders at major banks placed massive sell orders they never intended to execute, just to spook the algorithms and drive the price down. They paid fines. Hundreds of millions of dollars in fines. But to them, that is just the cost of doing business. Why would they pay millions in fines? Because the paper market is the only thing keeping the illusion of a strong dollar alive. If silver and gold were allowed to rise to their true value, it would expose the devaluation of the currency. So they created a paper market that dwarfs the physical market. For every 1 ounce of physical silver in the COMEX vaults, there are hundreds of ounces of paper claims traded. It is a game of musical chairs played with trillions of dollars. As long as nobody asks for the physical metal, the music keeps playing. But here is the twist that leads us to the 2026 scenario. In late 2025, the industrial giants stopped trusting the paper price. They started demanding delivery. When Tesla, Apple, and the solar manufacturers stand for delivery, you cannot spoof them away. You cannot settle with cash. They need the metal for their products to function. And that is when the paper foundation begins to rot. The banks are shorting a metal that the world is running out of. It is a mathematical impossibility resolving itself. This is the part nobody is looking at. While the banks were playing games with paper, the world changed. We are building a green energy infrastructure, and an AI revolution that runs on silver. Silver is the most conductive metal on Earth. It is not optional. It is essential physics. You cannot build a high-efficiency solar panel without silver paste. You cannot build an electric vehicle without silver contacts. And now, in 2026, we see the massive AI data centers springing up globally. These centers require massive amounts of electricity and high-speed connectors. Silver is the bottleneck. The mining supply has been flat for a decade. The easy silver is gone. We are digging deeper for lower grades. Meanwhile, industrial demand has eaten the entire annual supply. We are in a structural deficit. This is what economists call inelastic demand. If the price of silver goes to $100, Apple will not stop making iPhones. They will pay the price because the silver in the phone is a tiny fraction of the cost, but the phone does not work without it. The industrial users are not speculators. They are not trying to make a profit on the trade. They are trying to secure their supply chain. This creates a floor under the price that no amount of paper selling can break. We are consuming the above-ground stockpiles at a rate that guarantees a shortage. The vaults are emptying, and when the bottom is reached, the price does not just double, it disconnects from reality. Look at the gold-silver ratio. Historically, it sits around 15 to 1. In the crust of the Earth, it is roughly 19 to 1. But in the manipulated paper market, we saw it blow out to over 80, sometimes 100 to 1. That gap represents the suppression. But when the dam breaks, like we saw in the January 2026 scenario, that ratio snaps back. With gold stabilizing at record highs, silver has to move multiples higher just to return to the historical mean. The move to $121 was not the top. It was the signal that the paper market has lost control. When the ratio normalizes, we are looking at numbers that sound insane to the average investor, but are just basic math to the historian. The everything bubble is leaking, and capital is fleeing to safety. But there isn't enough physical safety to go around. The banks are trapped in their own shorts. The industries are desperate for inventory. And the public is just waking up. It will not be a market correction. It will be a transfer of wealth from those who hold paper promises to those who hold physical reality. The deficit can mathematically never be repaid with more paper. The only solution is price. A price high enough to destroy demand or incentivize supply that does not exist. We are watching the end of an era and the birth of a new monetary reality. Consider subscribing to this channel if you like this content, so you don't miss the next one. Thank you for watching.